This is why you always need to approach trading and investing risk first, right? Because you don't actually know when a catalyst like this is going to come through. Goodness. My name is Christopher Uhl. I've twice been awarded Top 100 People in Finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where we save time, make money, and start winning with less risk together as a team. Now let's get into the lesson of the day. So be sure to stick around to see how this video ranks out of 10, and of course, subscribe if you haven't done so already. So this video is called Tom Lee Urgent Warning to Investors from the Invest with Corey channel.
Tom Lee was just on CNBC talking about the current market situation and why it's pulling back. We're going to listen to what Tom Lee has to say. I'm going to explain and break down everything that he said and
All right, let's start that over, Rudes.
Why it's pulling back. We're going to listen to what Tom Lee has to say. I'm going to explain and break down everything that he said and why you should not worry about the stock market right now. Don't worry about subscribing, smashing the like button, or looking for the coaching and Discord link. We'll get to that in just a little bit. But first, before we listen to Tom Lee, I am hosting my free every single where else. Link to join is in the I hope to see you guys there.
Earlier today, but our next guest says the rise in yields could be a false flag. Let's bring in FundStrat Head of Research and FundStrat Capital CIO, Tom Lee. He's also a CNBC contributor. Tom, good to see you. Okay, so let's start there with the yield impact. What might people be reading wrong, you think?
Well, I wouldn't say markets are necessarily reading it wrong, but I would say as uncomfortable as we are seeing yields at near one-year highs, I don't think that this is going to be the level we see a few months from now. And I think that's more important because ultimately, if yields begin to fall because inflation pressures are easing, or if the job market is a bit softer than expected, it really puts the Fed back in focus. So
it does. In fact, this is a really neat tool. It's called the CME Fed Watch tool. Now, this doesn't predict all of the yield curve, but it does tell you where Fed funds are today and where they're supposed to go in the near future at their different meetings. I love this tool. I use this tool a lot when I do consulting with financial institutions. So if you want to find it, just Google CME Fed Watch. And so, for example, let's say it's January right now. So let's go 6 months out. Let's go to July. So it says the current rate of Fed funds is between 4.25 and 4.50, right, for the target rate. Now, it's saying that 6 months from now, there's a 41% chance it's still going to be there. 41% chance it's going to be down 25 basis points, a 14% chance it'll be down 50 basis points, and basically near zero chances otherwise. If we go all the way to the end of next year, they're saying a 40% chance of it being down at least 25 basis points. But if you add all this together, it's basically a 70% chance of some sort of rate cut over the next 12 months. And so I think that's really handy, really interesting. And that's really just talking about the Federal Reserve rate, but the Fed obviously has impacts across the board. So I think that rates definitely are going to be going down. I mean, there's a 70% chance that the Fed's going to go down. So there's definitely a good chance that rates overall are going to be coming back a little bit.
I guess what I would just say is it's not comfortable to be here at where yields are. I don't think it really breaks markets, but I don't think yields are necessarily moving higher over the next few months.
Well, it's particularly uncomfortable, arguably, for small
wish you'd tell me why they're uncomfortable. Why are we uncomfortable at this spot? I'd really like to know.
caps.
And if you know in the chat, please enlighten me. I would really like to know.
Last year, probably around this time, you made a bold call on how much small caps could rise. You've moderated from that since. But where do you see small caps going now? Why didn't the big pop that you projected for 24 pan out?
Yeah, small caps have been disappointing. I mean, unfortunately, I think there's been a rug pull on those names a few times. So I think investors are going to be very wary. But to us, I think the roadmap for 2025 is still one where the opportunity for stocks to have much better breadth widens, because not only do we have an incoming administration that is pro-business.
On that point, I was looking at the market breadth inside of OVTLYR. Let me go to that real quick and show you what I mean. So the way that we measure market breadth is how many stocks are showing up on the bull list with buy signals versus how many show up on the bear list with sell signals. It's either one or the other, bull or a buy signal or sell signal. There's no in-between signal. And so this green line here measures how many stocks are on the bull list as a percent. And you can see it's actually up at almost 50%. It's at 48% right now. And then we take a moving average of that line. So I like to use the 10-period moving average. And you can see the market breadth actually is increasing. We are getting more buy signals here. So I definitely agree with him on that.
And I think it is going to boost CEO confidence. It's pretty evident now, even seeing it in both ISM readings recently. But that's going to be a better environment for mergers. So to me, while small caps have been big laggards actually for the last 10 years. You know, this 10-year underperformance to the S&P is the worst in actually almost 100 years. So second only to 1998. And then from a valuation perspective, small caps are still much more attractively valued. The median PE is around 11 times, and that's almost 7.7 turns cheaper than the S&P. So it's been tough, John, to be overweight small caps, but I think they're going to work in 2025.
Okay. I do want to get your thoughts on some of the riskier.
Let's take a look at the IWM. So that's the small cap index. Oh, man. Okay. Couple notes taking a look at the IWM. First off, you'll notice these big blue and green boxes right there. Those are called order blocks. Those are large institutional orders waiting to be filled. And they work as really, really incredible support and resistance, but they don't always work, right? Here's a great example. This order block was built on December 19th and it closed underneath there. So that's going to disappear at the market open today. And if it can't find any footing with this order block built in September, I mean, it could be going down even further. But what I really want you to get across here is that actually, let me show you what this other top side order block is and why I mean, this is such a good example. So this order block was created all the way back in November of 2021 when it hit highs, right? That on the high candle, November 2021, there were a lot of orders of people wanting to buy and it went down, right? But the first time it came back to that area, the very first time it came back, it got rejected right here on this candle, okay? So that order block as a resistance point rejected it. The second time it came up into this area, another rejection. So this order block sitting here from 2021 just rejected price twice here at the end of 2024, starting 2025. And then a new order block was created right there. That I believe in, right? Drawing magical lines, you know, from like, oh, this point connects to that point. I don't necessarily get on with, but when I can see the data and they can plot it right there on the chart, I really get on with that. I really, really get on with that. And so point is that it's actually trending down, but it's got this really big order block right here that it might find some support with. So it's got the 10 period under the 20 period, price under the 50 period. So the blue is 10, black is 20, and the red is the 50 period. So if you look at it, that's like the short term, the intermediate term, and the long term. If they're all pointing in the same direction, that's where the trend is going, okay? Looking at this right now, there's nothing bullish to this about, or nothing bullish to this, bullish to me about this. That's what I'm trying to say. Nothing bullish to me about this. But longer term, I don't know. It's been like sideways for years at this point, right? I mean, if we zoom out and go to like the monthly charts, yeah, I mean, IWM hasn't gone anywhere since 2021. It's gone down and it's come right back to where it is, right? So that's been a 4 years of not going anywhere anytime soon. So I don't know about long term how bullish you can be on this.
Assets or the riskier parts of the market that, or I'll use the word maybe potentially more speculative. Case in point, the quantum computing stocks, they had a huge move higher. Jensen Huang from NVIDIA comes out yesterday, makes comments saying that, you know, some of the supercomputers are still, and the full, I guess, realization of supercomputers is still decades away. And you see all the stocks tumble. I know there's one that you like in your granny shots here. I believe it's IonQ. Just want to get your thoughts on what we've seen in some of these parts of the market and how to think about investing, if you should be investing in some of these more speculative or futuristic frontier tech-like companies?
I think investors do need to put a long-term lens on a lot of these important mega themes. I think quantum.
Oh my gosh. Look at these. Pounds are down a measly 2.5%, where you've got Rigetti down 45%, D-Wave down 36%, IonQ down 39%. These are giant numbers here, right? In fact, let's go look at each one. So RGTI. Let's go to the daily. Good gravy. This is why you always need to approach trading and investing risk first, right? Because you don't actually know when a catalyst like this is going to come through. Goodness. Okay, let's go to the next one here. QBTS. Ah, look at that. That one came up into an order block. Coincidentally, got rejected real hard. When was that order block created? I have to go way back with this one. August 2022, this order block was created when it was around 12 bucks a share. It sold off hard and then went sideways, or, oh, wow, it was under $1 for a long time. Jeez Louise. And then all of a sudden it picked back up around October, came right back into that order block smash. Now, obviously, that order block was really well timed, I guess you could say. And then the last one there, IonQ. IonQ. So again, huge trend from the 5s up to the 50s in the span of October to December. That's crazy moves right there. Wow. And this is what a trend is supposed to look like. When you're in a beautiful trend like this, your 10, 20, 50s, they don't cross, right? They don't cross. You're not getting any sort of pullbacks. It's just going to go. That's the kind of trend you want to buy and just hold until you get something like this that says, you know what, things have changed. Things have changed. Now, that does take off only a month's worth of gains from December 13th to today. But, oh man, those stocks got wrecked.
Computing is in the earliest days. I don't think anyone can judge really whether it's 15 years away or 15 months. And I think people have made many mistakes over the past 20 years looking at things like social media and underestimating the adoption rates there, or internet, or even AI now. I mean, just think about 2 years ago, how many people were saying AI was going to actually take far longer than expected. That being said, I do think the environment for stocks hasn't been great for the last 3 weeks. I think it's really gotten people into a recency bias thinking, look, we've neared.
I mean, to his point, right? We've really been selling off. We got a sell signal in OVTLYR on November 21st, and it did pop up a little bit from that point, but we're definitely below here, right? From that sell signal to today, we're down about 2% or so. So yeah, that was a warning sign, right? That sell signal that came through, that was definitely a warning sign saying, hey, now's the time to take profits. In fact, when I look at the dashboard right here and I see a sell signal inside of an uptrend, to me, that says, let's go ahead and sell to cash, right? Sell to cash, hold cash, and just see what happens. And what happens is, or at least right now, is that people are definitely getting a lot more fearful. In fact, we do measure that here in OVTLYR, right? You can see people got really greedy around mid-December, and then it just fell off a cliff, and now they're getting more and more fearful. So, as Uncle Warren would say, be fearful when others are greedy, and greedy when others are fearful. So, definitely is the time to take a couple dollars off.
The top, or that stocks are just awful now. I think we're getting close to the point where you should be betting really and leaning heavily against that. I mean, even look at AI sentiment; it's almost back to negative. But Morgan, regarding quantum specifically, it is a pretty innovative technology. I think these are going to be high volatile names. And so until we get back to risk on, they are going to be tougher names to own, but I don't think that means you have to sit them out in 2025.
So you heard what Tom Lee had to say. He talked about a lot of different things, and it's pretty much what I've been trying to explain to you guys, that the market right now is in a 3-week recency bias. It's overreacted to what's actually happening. A recency bias is the tendency to overemphasize the importance of recent experiences or the latest information we possess when estimating future events. Recency bias often misleads us to believe.
All right. The way he's talking makes me think about this right here. Right, this complacency, anxiety, denial, right? And like, we've just barely started. Like, if this is the top, right? Imagine this is the S&P, right? We did get a lot of complacency, and now we're starting to get some anxiety, I think is really what he's trying to say right here. And this market cycle guide here. And I don't know, it kind of sounds like exactly what he's describing.
Believe that a recent event can give us an indication of how the future will unfold. This is a problem because we have taken what's going on in the last couple of weeks to month, and we have come up with our own bias of what we think is actually transpiring when it's in reality not. And that's basically what Tom Lee is saying. And we have to also look at something else Tom Lee said that was very important. And I don't know if you guys really caught it when he said it, but it's the most important thing he said when he explained that small cap stocks are basically performing the worst they've had in over 100 years, with the exception of 1998 to 2000. With that exception, they're not performing well at all. Right now, small caps are trading at a median PE of 11 times, whereas the average is usually around 20 to 25. And Tom Lee said this earlier, meaning small caps should be performing at least twice as good, if not more, than they are right now. And the same goes for mid caps. That's part of the reason why SoFi, way back when, in April, May of this year, wasn't performing too well. Although it's more of a mid cap stock, it was really being hammered, and a lot of other stocks were as well. This is something to really think about. Also, small caps currently are 7 times cheaper than the S&P, and usually they're closer to 15 or 20. So again, it just shows you there's a 2 to 3x gap here on the small to mid cap, and this is due to a lot of factors. Recency biases just emphasize it even more negatively than normal. And the recent ISM readings are also good for small caps, mid caps, and mergers, acquisitions, and overall for business. this is not where the 10-year yield is going to be. Tom Lee said in the coming months going to come down. When the job market is softer than expected, that puts the Fed put back in focus. Feds can start cutting rates again. Right now, they can't do that because the job market isn't soft enough landing as they expected. It doesn't mean we're not getting rate cuts in 2025. It just means they're not happening as soon, like January or February is unlikely. We can still get them, but they're looking unlikely. Not to mention we have a couple of hawkish members that are replacing dovish members with the FOMC. So there's also that. Then there's the Donald Trump situation that is kind of stirring things up with the tariffs. We don't know how Donald Trump's going to handle tariffs. If he smacks tariffs on a bunch of different companies, including Canada and China and others, it's going to also create a little bit of distress in the stock market as well as the economy. Could push inflation up. I don't think he's going to do that, but the market does not like uncertainty. So as soon as there's some uncertainties in the market, people will start pulling their cash. Investors, big institutions, they put it on the sidelines, and there's $7 trillion sitting in money markets on the sideline. Another thing that's really hurting the market is the fact that people are selling off and getting out of quantum stocks due to what Jensen, the CEO of NVIDIA, had said about quantum being at least 15 to 20 years away and that it's way too early to invest. Created a lot of sell-off on those stocks as well. Before we get to what Tom Lee said about the AI stocks, we talk about the AI sector. If all of this is confusing you and you're really looking to learn in the stock market, or maybe you've been...
I feel like he's about to drop an ad. So while he drops his ad, let's go over here. And I wanted to look at the news, right? So we talked about how people are getting this recency bias, is what he's trying to say. I would say I think they came from complacency and are now starting to have anxiety. If this is the top, I'm not saying it is, but it's definitely a short-term top at the moment, at least. A lot of anxiety coming through right here. So I wanted us to see what the news stories are saying. So over here in Outlier, we can pop this open and we can see the most recent news stories and the sentiment behind those, right? So the S&P dropped 19% in 2022. Could have happened again as negative. S&P 500 wipes out post-election gains as bonds haunt, also negative. Best dividend ETFs, neutral. Pressures struggle on an all-time high rate climate, it's positive. Give yourself a tax cut, neutral. Okay. Why REIT struggles, positive. This one, I can't really tell. It goes off the screen. I think it's saying positive. S&P 500 negative. So it's pretty mixed. And all this came out in the last couple of days or so. Pretty mixed across the board, but I would say leans a little more negative than positive here. So let's catch up, see where he's at.
Stocks are making any movements. Now, wash sales don't affect other stocks. You could sell Coca-Cola for a capital loss.
Oh, he's talking about what wash sales for.
The issues abroad with China, Taiwan, Ukraine, Russia. Then you have the issue with Lebanon and Israel and Iran, all the geopolitical tensions around the world, all this wrapped up. This is not a good time. And historically, January is not even a good month anyway. So this is definitely not a good month to be trying to sell and make profits. But what it is a good month to do is to do what I teach in my Discord, what I teach my students to do, which is...
So many ads. Okay, let's go ahead and rank this video here real quick. So if I was to rank this out of 10, I'm gonna give it a 5. I'm gonna give it a meh. I mean, Invest with Corey didn't say all that much. Tom Lee did. Tom Lee had a lot to say, but Invest with Corey was like, "Hey, we're gonna do this thing, and then hey, let me throw some ads at the end of it." So yeah, I'm gonna throw this as a 5. But let me know in the chat what your thought is. What would you rank this video here? And of course, tell me what you're trading. I'd love to hear that in the chat. And come back tomorrow where we'll save time, make money, and start winning with less risk together as a team. And we'll see you later on in the OVTLYR trading room. Have a fantastic day. We'll talk soon.